Blue Financial Services sees interim headline earnings per share to be between a headline loss of 0.5 cent and a headline profit of 0.5 cent. That's compared to a headline loss of 0.24 cents per share in the prior comparative period. The group attributes the improvement in earnings to the cost savings generated as a result of right-sizing the organisation and an increase in lending as well. Johan Meiring, who's CEO of Blue Financial Services, joins me in studio now to discuss the turnaround strategy for the company. Johan, thanks so much for joining us today. Well, we talk about a 0.5 cent per share loss and a 0.5 cent per share gain. I mean, what are we looking at here in terms of where this group is headed? Because from the sounds of it, it looks like the company is at this stage moving from a loss position to a break-even position.
Yes, I think the thing to keep in mind is that in the previous reporting period there was a loss of 25 cents. And at this point in time, our trading update in essence is just alerting the market to the fact that we are moving towards a loss of 0.25%. So basically a 0.5 cent loss to a 0.5 cent profit. And that is ahead of our interim results, which should be on the market within the next 2 to 3 weeks' time.
So moving from that 24.5 cent loss reported in the comparative period to this position right now, whichever way it swings, I mean, it does ultimately spell a change in your position. So let's go through what you're attributing the turnaround to, because we've seen extreme cost savings generated over the course of this period. Run us through how so.
Yeah, I think when we started with our turnaround strategy, we said it would take approximately 18 months for us to get to a point of sustainable profitability. And we're really about halfway now, so it's sort of the halfway or the midpoint. And in terms of our projections of what we wanted to achieve, I think we're sort of on projection and possibly even slightly ahead of the curve.
Let's drill into some of the numbers there, because back in last year's period, I mean, you had runaway costs. They were coming in at, what, 55 million rand per month, and that was quite a problem. So what targets have you managed to hit?
On the cost containment, which was a key criteria, because as you mentioned, at 55 million rand a month, it wasn't sustainable based on the revenue being generated in the group. We managed to get the cost of 55 million down to a cash cost of approximately between 21 and 22 million rand, which is a significant saving that was achieved. But with that, of course, you can't if you cut cost, you also have to grow your headline earnings. And the other key thing that we focused on was to start production in our lending operations again, because that is a key component from a growth perspective.
Let's focus on those matters of business, because there's been, as you say, an increase in lending activities and a resultant book growth that we've seen come through. How does that growth stand relative to the kind of impairment levels you're dealing with right now? Because we're still within a situation where the South African consumer is in a distressed position, perhaps better off than where they were last year, but distressed nevertheless.
I think it's important to keep in mind that we're a Pan-African group, so we operate across 12 countries, of which South Africa is but one of them. And as part of our growth strategy, what we in essence did is we started focusing on all the other African jurisdictions where we believe the trading conditions were easier than in South Africa. So in South Africa, it currently constitutes roughly 4% of our business. That may change in the next year or so, but currently that is the position.
Let's take a look at trends then within this micro lending business and what you're actually seeing, because at one stage you assume status as most expensive micro lender. How has that shifted within the scenario? And let's talk on an African scale.
When we started with our turnaround strategy, it was really important for us by the introduction of our new values being respect, reliability and returns. Now, we can't really be the most expensive microfinancier on the continent and then still claim to respect our customers. So the first thing that we needed to do was to come out with a benchmark to make sure that the pricing that we do across the continent is equivalent. So sort of on the Big Mac index type principle. So we took our lending rates from a South African perspective, and by applying a few calculations to it, we've in essence normalized our rates, which actually meant that there were huge reductions in our rates across the continent.
Within what kind of competitive environment on the continent?
Clearly there's lots of competition on the continent, and it's different in different countries, so it's a bit of a difficult question to answer on a global perspective. I think depending on which country you're talking about, there are some very good competitors, but I think if you got the right products, the right systems, and you service your customers in an appropriate way, you'll always do good business.
Okay, let's take a look at where you see most opportunity being derived on the continent right now, because you say there's this focus on Africa. So looking at that expansion strategy, are you pretty much dedicated to all territories, or are there focus points at this stage?
They're definitely focus points. I mean, we're trying to get all the entities to be profitable in their own right, but they're definitely focus points. One of our focus points at this point in time is East Africa, and we're currently on a drive to increase our points of distribution to reach more customers and to service them more efficiently.
Yep. When it comes to servicing them more efficiently, what exactly are we looking at? Because we know on the continent, targeting the unbanked has very much become a theme, broadly speaking.
Yes, I think the first thing is you need to increase your points of distribution, so you need to be able to reach customers. So in certain of the more high central areas, there's obviously lots of competition, but when you go to the more outlying areas in certain countries, there's definitely less competition, and if you've got your points of distribution in place, it's easier to reach those customers. And then when you're dealing on the main CBDs or the centres, it's a question of, can you make it more convenient to your customers and by giving them some form of innovation?
Yeah, challenges in actually getting that right and, you know, progressing forward now with this turnaround strategy that is taking effect.
I think it's important to keep in mind that if you're operating in 12 countries, it is 12 countries with 12 different regulatory environments, different cultures, and every country's got its own subtleties, and a person needs to be respectful of it and operate within that environment. And that is also a challenge for us from a perspective of perfecting the turnaround. But I must say it's going quite well at the moment.
Well, let's leave it there. Johan, thanks so much for your time this afternoon. Johan Meiring is CEO at Blue Financial Services.